With the candle impulse theory alone, you will be able to trade every single candle on every single time frame on every single pair. Now, as you can see right here, throughout this video, I'll show you the candle impulse theory that will allow you to catch every single trade on every single day, as well as using this on both your higher time frame and lower time frame as confluence. And I'll show you guys the entry models that you will exactly use to catch all these trades. This itself is better than the candle range theory, the CRT, that I've been teaching you guys about. Now, the candle impulse theory is the only way to trade every candle. As you can see right here, this would be the model 1 using the PCC, our previous candle close, okay? Now, our goal once using this model, okay, the fundamental understanding is that on a bullish example, we are always looking to buy under the previous candle close. And on a bearish day, we are looking to trade above the previous candle close. As you can see right here, if price closes above the previous candle high, right over here, price closed above this previous candle high, there's a high chance that the next candle will look to exceed the high, following and continuing the trend of these impulses. As you can see, this would be a normal bullish day, and you guys have all seen this, but you've not been able to fully trade it to its maximum potential. But that is what I'll be showing you in detail on how to do in this exact video. So make sure to take notes and watch the entire video. Okay, guys. Now, the most important part is the close of the previous day candle, okay? As you can see, this would be an example of us using this on a daily time frame. Here is our Tuesday candle, Wednesday candle, and Thursday candle, okay? Now, also understand the anatomy of the candle, which I will be showing you guys in later on in the video, is that we can see that price makes an expansion to the upside, okay? We then have a new candle that is formed, okay? And then we have a new candle formed right after that. Now, before this candle even prints, our main focus would be 3 main things of the previous day candle, okay? Know the high, the low, and most importantly, the close of the previous day, okay? In that exact moment, once this candle closes, this candle opens, okay? But once this candle opens, it needs to make a low of the day. And majority of the time, the low of the day will happen below your previous candle close. And that's where the understanding comes that we look to trade below this area. As you can see right here, price closes and opens it. And in that exact moment where we can see price makes a dip down below, you can look for your normal FEG market structure shift entry to then look to trade the entire candle of that new day, okay? Your Wednesday candle time frame and then your Thursday candle time frame, okay? Now, we don't really focus a lot on the previous candle open, but that also stays there to help for our understanding of this entire model, okay? Opening, low, high, and close, okay? Opening the new candle, low of the new candle, high of the new candle, close of the new candle, and this will repeat itself. Now, this is a live example of this on Nasdaq this week, okay? As you can see, 3 preceding bullish candles, which all could have been traded using the CIT model, okay? And as I said, our main focus is to be looking to trade below the previous day candle close. And within that, you're finding a trade at the wick of the new candle, okay? That's why I say you're allowed to trade the entire new candle with this theory, okay? As you can see right here, this should be your previous day candle close. Right over there, marked out. And this would be your Wednesday candle. This candle right over here to be exact. You can see it makes a high, but then it comes back down to make the low of the day. As you can see right here, this will be a very tight entry entering at the wick, but price does come back to give you an FEG entry right over here where you could have entered and then traded into the high, okay? Once price closes, okay, we use the exact same model right here. We start to see price expands upward, okay? But in the start of this new candle, we see price dip down below the previous candle close, okay? Within that, beautiful market structure is displayed to us, and we have an FEG entry where you could literally trade it the entire new day, okay? Very expansive candle, okay? And if you're very keen to understand, this would be your normal accumulation, manipulation, and distribution setup. Okay. Now coming on to the Friday candle, we see the exact same thing. We close right over here. Okay. And within that closure, we also start the new open of the Friday candle. Okay. Thursday closes here, but Friday opens in that exact same candle. Okay. Our main focus is when price dips below this area. As you can see, it dips quite expansively into here, but then you'd be looking to wait for that bullish reaction to continue the new preceding candle. Okay. Now you can also see right here, I have marked with the midnight openings just for you guys to also see clearly of the separation of these new days. But all of this is your main focus, the wicks of all of these candles. Okay. Now you need to be also looking to trade this model in a trending market. That is where you see the impulse theory come into play. Okay. And ideally you want to be trading on a pair that is supported by high to medium folder news to have that increased volatility. Okay. Now, the best way to track your news would be using an economic calendar, which is presented to you right now on fastbull.com. Also, if you do want the link to this exact calendar, it'll be in the link in this description of this video. Okay, guys, fastbull.com. Just you want to filter out to the 2-star and the 3-star news, which will be your medium and your red folder news. Okay. Right here, you can see that on this specific day, we have UK house price index, and it also gives us a very good annotation that there's a high chance that on GPUSD we will have bearish sentiment. Okay, so on that specific day, you'll be then looking on your higher time frame candles for a bearish CIT, looking to trade above the previous candle's close and trading into the high of the new day. Okay, or the high of that new candle. Okay. Also, another cool feature is that you guys also have access to a whole chat room, so you can also communicate with other traders on what their opinion on a specific day will be. Okay, guys, you can also look here to also trade in and talk about your own experience. Okay. And you can also come up and create a whole new group where you can also communicate with your other traders in your own community. Okay. Now, let's try to use some of the concepts I just taught you. Okay. So on GPUSD on the 4-hour time frame, as you can see, all of these days are proceeding to be bearish, are proceeding to be bullish candles. Okay. Now you could have came in and marked out this previous day, this previous 4-hour candle close. Okay. Go on to your lower time frame, and as you can see right here, here is not the cleanest, but it is an example that we can use in this example. Okay. We see that we have this gap in price. However, we close right around this area. Okay. In this, we start to see that price dips down a low. Okay. This is a gap of the new week. Okay. But within this, you'll be looking to trade usually to catch the low or wick of the day. Okay. And as you can see, this candle is still playing to proceed out to the upside. Okay. You can also do this for your previous day candle. Okay. You can also use this for your previous 4-hour candle. Example right here, previous 4-hour candle close right over there. And this one didn't specifically make a wick, so we can't fully use this one. Okay, but yeah, here we have a previous candle on the 4-hour. We mark out that closure. And going on to the lower time frame, we can identify. Yeah, as I say, guys, you want to always make sure that your chart is on UTC -4, so you have the exact time frame. As you can see, there's also a midnight candle. And as you can see, what happens is that previous candle close, we are pushing above. However, we then come back down and we react off of the previous candle closure. Within this time space, you then look to see price make a bullish reaction, because you have to understand that this is the low and wick of the new candle. Okay. I'll actually mark this out here. That will be our new candle low. Then you can look to play into this change state of delivery. Okay, change. You can also play into this change of this market structure shift. Okay, with this fair value gap, and then you can look to enter playing into the exact new and trade the new 4-hour candle. Okay, and as you can see right there, exactly where you marked out, you got your entry right at the wick of that new candle. Okay, and you can do the exact same and you can also play the exact same theory with all your preceding candles. With this specific scenario right here, you would have to use the CIT model, which I've also taught you guys about. As I said, that'll be in the cards of the video. But as you can see right there, candle low, and then we break that range, and we come to proceed to make the high. Okay. As I say, guys, all of this was done on fastball.com. You guys want the exact link to this will be in the link in the description. Okay. Now, it is always important that I remind you guys of the anatomy of a candle. This is a undefined candle right now, but we can use it in both ways. We're able to see this as a bullish candle. We then see this as our high, our low, and this would be then our open, okay? Our opening price. But our main focus, if this was seen as a bearish candle, this would be your high, your open, close, and low, okay? If you're looking to use the CIT, you want to be trading above that candle, trading low, okay? And for a bullish candle, this would be your low, high, open, okay? And then close. For a bullish day, you look to see price close at this price and then open with the new price, dipping below under the previous candle closure, okay? And then you can look to trade into the new day, okay? And that is how you trade the exact new candle, trading every single candle using the candle impulse theory, okay? We have an example of this right here. Previous candle close, buy below, okay? Previous candle close, buy above, okay? Sell above. And right over here, as you can see, we're always looking to trade the wick and using that to our advantage. Price close right there, and the new candle opens. It expands upward above that previous candle close. And right over there, you're then looking to see price make a market structure shift and then start to play lower. Also, a key understanding this is also one of our key entry models, the turtle soup model. Trade the next candle. Now, these are very important times that you want to focus on: the midnight open and the 8:30 open, as well as if you're trading this within London session, you want to be trading this in between the 2 a.m. and 5 a.m. If you guys also need other indicators to mark out your midnight open and your 8:30 open, here is the Alpha IC Trader. Now, here's how you're going to use this as extra confluence to your previous candle closure. As we previously discussed, that on a bearish day, you're looking to trade above the PCC. And on a bullish day, you're looking to trade below the PCC. However, the same could be said and used as more confluence for your 8:30 open and midnight open, okay? On a bearish day, you're looking to trade above the midnight open and the 8:30 open, okay? Here's an example of this. Here's our midnight candle right over there, and there's our midnight open. Right over there, you can see price keeps on extending lower, and here's where you're looking to start seeing bullish reactions. We can look to then target, okay? Higher. And then later on in the day, we then start to see the 8:30 open, okay? So this is our New York opening time, okay? And as you can see, price then dips down below, giving us multiple chances to enter off of an old block right over here, a new market structure shift, and then another tap into old block, and then making a tap into the old block, and then you can extend higher into the start of the new day. As you can see right here, you'd also want to have in confidence maybe price that the PCC would be around in this area, so you're both below 8:30 midnight and the previous candle closer. That would be your highest confluence trade of the day. Okay, same thing right here. Midnight candle, midnight open, price extends lower, and in this time, once you start to see a slowdown of this bearish reaction and a new forecoming of bullish reactions, you can then look to start to enter also within that London entry time frame of 2 a.m. to 5 a.m. Eastern Standard Time, looking for a good risk to ratio. And then as you can see right here, price then comes back and reacts off the midnight open, but extends back down where it makes your 8:30 open. Once again, price dips below this area, and once again, it gives you a market structure shift with an order block entry right over there, and the new target looking to trade into the next day or next candle, okay? Now, as I said, your entry model that you want to use is the turtle soup. Here would be your PCC, and here would be your impulse, retracement impulse. However, this is seen as your short-term low. Price breaks that short-term low that is full with liquidity, makes your turtle soup, and once price starts to react to the upside, you're looking to enter with that new impulse to the drawn liquidity, or even to the high of the next candle, okay? Or even to the high of the previous candle. it right there. Impulse retracement, short-term low, price breaks below that, okay? And you're also below your PCC. This is beautiful for a bullish trade, okay? And then you look to target higher. Now, the next model that you want to be using confidence is your AMD, because the AMD is directly correlated to your candle opening and candle closure pricing, okay? Usually within that opening, usually within the close of a previous candle and the opening of a new candle, we see a lot of consolidation, and that in itself can be identified as our accumulation in price. As you can see right here, price closes right at this candle and we start to open the new candle. However, we are starting to see that there is consolidations, but we understand this as our accumulation. Once price breaks above that to make the manipulation, we can then look to trade into the distribution and then see price extend down lower for the low of the day, okay? As I said, the PCC, okay, your previous candle close, and at that same moment, you're having the new opening price. Bearish candle right over here, and then a new bearish candle. Now, what time does the daily candle close on NQ and ES, so your NASDAQ and your S&P 500? That will be 5 p.m. Eastern Standard Time. Make sure your trading chart is set to UTC -4K. This is a very important time for a lot of the futures traders if you're going to be trading this model too. So on your time frame, you usually see that 5 p.m. is usually skipped, okay, on your trading chart, okay? That is because the New York Stock Exchanges closes at 5 p.m., okay? Now, these are the time frames that you want to focus on: your daily and your 50-minute time frame and your 4 and 5-minute time frame, okay? Now, this exact model is, I've also given a whole PDF on this exact model too in my Discord link in the bio, okay? So you guys do want access to this, make sure to join the Discord link in the bio. And as well, if you'd like to get a free one-on-one call with me, make sure to book with the link in the description, okay, guys? Now, the tap and go model focuses on the equilibrium level of the previous candle, okay? This is our previous candle, but you focus on the 50% of it, okay? The concept makes use of the understanding of the premium and discount pricing. For a bearish move, the new candle must make a retracement into the 50% of the previous candle, okay? And this would be the exact same for a bullish example, or vice versa. This usually leaves a large static wick, and the entry is done by using either your AMD or total soup model once the new candle reaches the previous candle's equilibrium, okay? As you can see right here, this is our range high, low, 50%, okay? Price comes back and taps into the premium of a bearish day, okay? And from this entry point, you're then looking to trade down low, okay? Previous high time candle and then use the new candle and you're trading down low, okay? So you're literally trading the new candle's wick, okay? And here's a beautiful example of this: daily, high, and low. We then have the 50% of the previous daily candle. And as you can see, the new candle opens, okay, and dips into 50%. And from here, you can look for your market structure shift, tap into old block, and then trade the new candle of that day, okay? And yeah, exactly was the same thing I showed you guys in the beginning of this video. Using the tap and go and using the PCC CIT model, you could enter off of every single candle in this range, okay? Using the 50% equilibrium. Price comes back, taps the equilibrium, and then extends lower. New candles, equilibrium, price taps above that and extends lower. New candles, equilibrium, price taps above that and extends lower. New candles, equilibrium, price taps above that and then keeps on going lower, okay? Within this, you are entering in all of the wicks. As you can see, yeah, all of the entries you would have to use using the CIT PCE, okay? Total soup here, total soup above that high, another AMD accumulation, manipulation, distribution, and once again another total soup. If you guys need more understanding, okay, of this exact model, please go watch the previous video on the candle range theory, where I also explain how to use that in confluence with this model. And you want to book a one-on-one call with me for free, make sure to book with the Calendly link in the description, as well as check out fastbill.com economic calendar. And I will see you guys in the Discord link in the description, guys. As always, guys, see you guys in the next video.